Joining us now, Guggenheim's Michael Morris. He has a buy on the stock. Let's just start off on sort of this news. What's your reaction to it? You know, is it more part of their cost-cutting plan overall, or do you think it is a real response specifically to DeSantis?
I think it's really part of the cost-cutting effort. I mean, it's hard to dismiss any sort of mix with respect to the political situation right now, but Disney, I think, is playing the long game here with respect to how they're structuring the business. And I think they already had pushback internally from the employee base on some of the move from the West Coast to the East Coast. And the most efficient and simplest path forward is to move on from that approach.
And what are your expectations when it comes to cost cutting overall? We cited a couple of other things. One, of course, a Florida-based hotel attraction, so to speak. But, you know, where are they in terms of how much Iger has promised to take out? Not just for the content budget, but overall operating?
Sure. I mean, the company's talked about cutting in excess of $5 billion of costs of the business across content and a number of infrastructure and underperforming sort of parts of the business. And it's such a complex company, as you know. I heard what your discussion on the business about an hour ago and agree with a lot of the sentiment that you highlight. We are looking across some things in parks, but really mostly media and overhead right now as the areas where this company and probably most of the media industry at large has been overspending for the last decade with respect to serving their consumers. And now is just the time to start right-sizing that. And really, I think the company's on a good path, but expectations for their ability to do that still remain very high.
Yeah, I mean, across the board when it comes to, let's call it old media, I hate to say that, given where I sit right now. But, you know, the decline of linear networks only seems to be increasing. We talk often here, it's certainly about cord cutting, which seems to actually be picking up speed, not sort of reaching some kind of slow end. What are your expectations there, and how much pressure is that putting on not just Disney, but Warner Brothers Discovery, Paramount, my parent company, to continue to sort of cut costs when it comes to the direct-to-consumer that's consuming so much of the cash flow?
Yeah, it's a great question. So there's a tremendous amount of pressure, as you know. The cord cutting in the first quarter of this year was at the highest levels ever, both on a gross numbers basis. Over 2 million subscribers left the bundle in the first quarter of the year, and on a percentage basis, right? So those high numbers are off a lower base. I think the issue really, and maybe we have a differentiated view here, is not about cutting costs to try to keep pace with this rate of decline. It's about an understanding that the business model has just materially changed. The days of charging the consumer for X content, even though they only want Y, I think are in the past. I think that all of the media companies, inclusive of Disney and even inclusive of Netflix, have to look and say, look, what is the core product that we're trying to serve the consumer? Where can we be excellent? And then build a business from that. I think Disney is actually in a great place over the long term. I think that Disney branded content is incredibly unique for that. I think the assets that they have in sports are very unique, though expensive, and they need to figure that out. And general entertainment, they do have a very healthy general entertainment business, but they have to really make the decision if they want to compete with Netflix and HBO in that space and not just have their general entertainment business tag along with the success of Disney and ESPN.